Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll look at the outlook for interest rates after surprisingly high headline inflation figures, and we'll look at what banks are doing with fixed mortgage rates. We'll also look at today's retail sales figures, which were way above expectations, and pose some new questions for the Reserve Bank. And finally, we'll look at the latest on the global credit crunch. It really does get worse. In particular, fears that a downgrade of the world's biggest bond insurers could spark new chaos in financial markets. Firstly, a bigger than expected rise in December quarter inflation to above the Reserve Bank's target band has increased the pressure on the Reserve Bank to hike interest rates. But economists say a hike next week is unlikely given the turmoil we're seeing in global credit markets. They say signs that non-tradable inflation is easing will also give the Reserve Bank a reason not to hike for now. However, ASB announced this morning it was putting up most of its fixed mortgage rates. Now all of the ASB family, that includes Sovereign and Bank Direct, have put up most of their fixed mortgage rates by about 20 basis points. ASB is the last of the major banks to put its rates up to pass on higher wholesale funding costs in the wake of the global credit crunch. But ASB has kept its fighting rate for 5-year mortgages below 9% at 8.99%. This means ASB is positioned below BNZ, Westpac and ANZ National, who all have their 5-year rates at 9.15%. How long before those banks adjust in this highly competitive area? Remembering, of course, that the 5-year rate is well below the usual benchmark of the 2-year rate at 9.6%. And in other news on the economic outlook and what it might mean for interest rates, retail sales rose a much stronger than expected 2% in November. This confounded pundits who had predicted that high interest rates and a slowing economy would douse the enthusiasm of shoppers ahead of Christmas. The data is bad news for the Reserve Bank, which has been looking for signs of a slowing economy to justify keeping interest rates on hold next week, at a time when inflation is above its target band. Seasonally adjusted sales rose 2% from October, and total unadjusted sales were up 6.9% from December a year ago. Remember, this compares with 0.7% as the median economist forecasts, so 2% versus 0.7%. Spending on fuel was the major culprit. That rose 9% in November. Motor vehicle retailing up 4.3%, supermarket spending 1.6%, and cafe and restaurant spending 3%. All signs the economy's running hot. Now it's time to look at the fallout from the subprime mortgage crisis. It worsened overnight as Merrill Lynch reported a massive loss, and we're seeing fears now that bond insurers will be downgraded. This is throwing doubt on the ratings for $2.4 trillion of debt. Merrill Lynch wrote off more than $16 billion last night from the value of its bond portfolios, and because of expenses linked to the subprime crisis. This was much bigger than analysts had expected, and forced Merrill Lynch to report its biggest ever quarterly loss and its first annual loss since 1989. This follows Citigroup's massive write-offs earlier in the week and capital raisings worth more than $20 billion from Citigroup and Merrill Lynch to bolster their balance sheets. But the biggest news overnight was warnings from Standard & Poor's and Moody's that they might downgrade the AAA credit ratings of two of the world's biggest bond insurers, two companies called Ambac Financial and MBIA. Listen out for those names, you'll hear more of them. This has thrown the market into a real spin for a couple of reasons. Ambac and MBIA are big in the credit default swaps market, which has been used in the past by holders of bonds to protect themselves from the risk that the bonds will default. The least risky bonds carry AAA credit ratings, in part because the insurers of these credit default swaps themselves have AAA credit ratings. If the insurers' credit ratings are cut from the best rating of AAA, then banks and others will have to write down the value of council and state and other highly ranked bonds worth $2.4 trillion. Bloomberg estimates this would force banks to write down the value of these bonds by around $200 billion. This is on top of the $79.6 billion of losses they've already booked. This would also require the banks who hold the bonds to ask for yet more cash from friendly investors, such as the rich Arabs and the Asian sovereign funds. But how much more can they pump in? The FT.com reports on this risk of the banks being forced to ask for fresh cash injections. This would be on top of the $52 billion already pumped into the world's banks to bolster balance sheets. Things are getting tough in the credit crunch. I'm Bernard Hickey for interest.co.nz. I'll be back on Monday with another daily briefing.